Hello and welcome to Bazaar Morning Call. You're watching us live from the CNBC-TV18 Motilal Oswal studio. I'm Sonia Shenoy, and joining me this morning are Nigel D'Souza and Surabhi Upadhyay. Folks, start of a new day, start of a new month, and where did these 7 months of this year go? I have no clue, but it's a brand new month.
Well, that's right, and we have mixed it up today, right? We have got a tinge of green as well as red. So, but I think
that's
the green,
what makes a perfect market, right? Some green, some red.
I think the green's outweighing the red, but let's see how that goes. For starters, at least we're getting it right.
Absolutely, and I hope so, right? For the sake of the bulls, that the green outweighs the red. So it's the start of a brand new day, and we have plenty of cues to talk about. So very quickly, let's run through them. Now, the global cues are strong. The Dow ended up in the green yesterday, up about 100-odd points. But it's not just yesterday. If you look at the scorecard for the month of July, it's been a rollicking ride for the global markets, right? I mean, the Dow, the S&P 500, the NASDAQ. But the star of the show undoubtedly has been the Russell 2000, which is the small cap index, a clear indication that there are signs now of a widening market rally globally and in our own markets as well. So the Russell 2000 index saw a gain of almost 6.5%. In that context, plenty of cues to watch out for, through the course of the next 24 to 48 hours. There's a lot of data in the US that comes out later today. There's the June job openings, there's the July manufacturing PMI, so keep that on your radar. And for our own market as well, once again, the bulls are sort of tightening their grip on the market. We closed almost at the high point yesterday, holding on very tightly to that 19,750 mark. And if you look at what's happening in terms of the FI figures as well, the selling has reduced considerably in the last couple of days. So 3 days ago, there was large selling, almost 4,000 crores. In the last 2 days, about 1,000 crores. And yesterday, that selling has come down to about 700 crores or so. So look, things are looking quite good. A couple of things to focus on, and we'll talk about them in greater detail in a bit. One, of course, is the auto sales numbers that come out for the month of July today. And there is weakness across the board. In the wholesale numbers, there's been, high amount of discounting in passenger vehicle sales. Rural market has not recovered just yet. So that's a pocket you need to be a bit cautious about, considering the rally in the stocks. And the other thing is Maruti numbers. Weakness in the margins, as well as that SMG acquisition has not gone down very well with the street, because there will eventually be a cash outgo, and it's sort of change in the rationale of the management. So more on that in a bit. But I think these are a couple of things that could perhaps dominate Mindspace today.
Well, that's right. Sonia, the 20 DMA seems to be the reference points for the bulls, both for the Nifty as well as the Nifty Bank. Because the last few sessions, we're going to seeing a bit of a recovery. But really, the headline index could be in a bit of a range. The real parties in the broader markets. And yesterday, yes, the Nifty recovered, but the breadth of the market was very, very good. You had the small cap and the mid cap indices. They put on close to around 1%. So clearly, individual stocks, they're doing far better. What did the FIs do? Well, they added shorts yet again. They added close to around 7,000 short contracts. The long positioning has come down to around 51%. This is a more realistic picture. And you like some shorts in the system, because some kind of good news, if the flows are not picking up in the cash market, you have shorts in the system that could take the markets higher. Now, at the start of the series, the net long positions were close to around 33,000 contracts. That's come down to around 5.7 thousand. So that's down by close to around 80% just in the last 2 to 3 sessions, telling you the kind of short addition we've seen and some kind of unwinding on the long side. This is not a bad thing. This is a good thing. But the bigger positive for me is the FIs continue to write puts. And yesterday as well, they wrote close to around 1.5 lakh puts in the ratio of close to around 2 puts for every 1 call. And the point I was making, that reference point seems to be 19,550 to around 19,600. Last few sessions, we have gone to that vicinity. And from there, we see a big recovery, 50 to around 150 points odd. So clearly, that's the buy zone. Today's Nifty Financial Services expiry. So the last 60 minutes will belong to the Nifty Financial Services. The highest open interest is at around the 20,500 call. Premium out there is roughly around 20 rupees. On the downside, though, we have seen writing at around the 20,300 put. And the premium out there is around 37 rupees. So just punching in those premiums as well as looking at those strikes, you have a broad range. On the downside, 20,250. On the upside, 20,520. The gift Nifty, well, the last time I checked, was suggesting some green, because the Dow futures as well were higher. But just want to put one point on the table. Brent as well as dollar index, they're a little bit at uncomfortable levels. They're the highest we've seen in the last few weeks. So just keep an eye out. Brent crude prices at around $85 per barrel. The dollar index is well closer to around 102 odd. So I mean, obviously the trend is up, but this is making me a little bit uncomfortable, the way Brent as well as dollar index is moving. So what else?
Count me in on that, and I'll come back to dollar and Brent in just a bit. I was looking at a picture that's beyond just today, because we're starting a new month. And one thing that is very, very clear to me is that if there's one trigger that can make us take out this 20,000 mark, it's not earnings, it's not a fundamental trigger, it's got to be money, the sheer power of money. And that's working very well in the bulls' favor. And I'll come to the numbers in just a bit. On results, we've not seen any major positive surprises in the last one odd week or so. This is not one of those outlier quarterly seasons where you've had a phenomenal move up in a couple of major stocks which lead to upgrades. In fact, no one's talking of upgrades just yet. And yesterday's numbers were exactly on that line. Maruti, of course, Sonia will talk more about that, why it was disappointing on the margins. If you're talking power grid, well, the profit's down, the revenue is more or less flat. Chemical companies have their own set of woes. So short point, results are not delivering that next kicker for the market. So therefore, the bulls will rely on liquidity. And I'll come to the money flow picture in just a bit. Now, the Nifty had hit the high in this recent run-up on the 20th of July. That was the 19,991 mark. Since then, it's been consolidating. So it's been 7 days of consolidation. But what's positive for the bulls is that there is no case of lower lows being formed. It's consolidation with a bit of an upside bias. And yesterday was a case in point. Now, the global picture. Markets have muddled along. The S&P is up about 3%. We're up about 2.5%. The European markets are in the middle. The interesting facet in July has been that this major Japan trade, that's taken a breather. Japan has actually underperformed. The market to watch out for is China because the re-enter China trade has begun and the Hang Seng is a case in point. Even today, the Hong Kong is the strongest market in our neighborhood. Now coming to the flows picture, and here there's no problem whatsoever. Sonia was talking about the selling coming down in the last couple of days. Look at the final tally, overall tally for the month. We are again at about 46,618. That's the total inflow coming in the month of July. We were at 47,000 crores in June. We were at about 44,000 crores in May. And April is when the rally began. That was 11,000. The sheer power of money is what's taking this market higher. And my guess is that it's got to be more of the same because earnings are not really delivering that. But money can really turn all arguments on its head. And it's a very solid picture for the month of July. Now, the three factors that I would watch out for very, very carefully, not just today, but the next couple of days. One would be China. The question that we're asking is the China re-entry trade going to gain more traction? This money flow that's come into India, some of that is on account of China. So will people start switching back to that big neighboring market? The second is dollar. As Nigel was pointing out, the dollar index was at 100 in the middle of July, 13th July. Now it's at 102. Need to watch for this. And the third and a very big cue for us, of course, is oil. We are at 3-month highs on Brent. The level is above $85 to the barrel, and that will always be slightly uncomfortable. So, yes, inflation, food price inflation here in India, oil inflation, some factors to watch out for. But hey, guys, when the money is coming in, none of these factors matter, and we know that.
Oh, absolutely, right? The power of liquidity. But lots to talk about on the show. And today, the GIFT Nifty is indicating the start will be in the green. So we'll take it from there. First up, we have one of the brightest minds in the business, Surendra Goyal of Citi, talking about how their emerging market equity strategists have recently raised their emerging market, to overweight in their global allocation, citing increasingly balanced risks to global economic outlook. He says, from India's perspective, in his view, improvement in relative preference for China may pose a near-term FI active weight reduction risk. He says they have upgraded metals to a neutral, added Tata Steel to their preferred list, and removed Indigo from it. He also says they are overweight on banks, autos, PSU, utilities, and defense, while they are underweight on consumer durables, IT, and metals. So he's making the same point that you did, that China could, emerge as a bit of a threat for investors.
Yeah, because it was short China. Let's go to other markets like Japan and India. That was what played out in the first half. Second half, is that going to turn? So need to watch out for that. Let's get to the rupee then. Money market action coming in. Abhishek Goenka of IFA Global says the rupee weakened last week and has underperformed its Asian peers in July. He says the RBI placed a firm floor under the USD INR pair around 81.70 to the dollar. He says the central bank's resolve, coupled with the rally in commodities, especially in crude, along with the dovish Fed, ECB and China stimulus measures, has caused the rupee to underperform. Overall, he expects the USD INR pair to continue to trade in a range of 81.60 to 82.90 over the medium term, with the possibility of an eventual break lower if broad dollar weakness continues.
Okay, and on the bonds, Ajay Magnolia of JM Financial says, amidst worries of rising inflation, domestic yields have been climbing up, mirroring the rise in US yields post the robust GDP and labour data. He says all eyes will now be on the RBI MPC decision next week. Ajay says with no major domestic cues today, he expects the 10-year benchmark bond yield to trade in a range of 7.14 to 7.19%.
Well, we have a lot of stock-specific action to track for you. Get to that in just a bit from now in our special Talk Time segment. For the time being, let's run you through the list. Stocks that could react to positive news flow include JBM Auto, Petronet and DLF. While the other stocks could be reacting to negative news flow, we have Maruti, Power Grid, IRB Infra, Bosch, UPL, Oberoi Realty and KGI Industries.
Okay, let's get the first conversation going. This morning, Dean Kim, Head of Global Research Product at William ONeill, is with us. Dean, good morning. Great to have you on the show as always. You know, we've been debating this over the last couple of minutes. I don't know if you could hear us already, so I'll straight away get to that question. As we're looking at the second half, August onwards, I think a lot of people here in India are wondering whether the money will keep flowing into this market or whether China is now attracting more eyeballs and more wallets, because suddenly in the Chinese market, Hong Kong and even the mainland markets, they have started doing really well. What's your sense as you look at the next couple of weeks?
Yeah, China certainly has provided some stimulus, and that seems to be getting the market going. However, you know, I was just looking at the GDP growth forecast for China versus India. And India is still stronger in terms of GDP growth heading into next year and beyond. So I think China has more work to do in terms of providing more stimulus to its economy. And if they were to come out with more stimulus, that could be good news for the market, and perhaps that could sway the liquidity over to China. But as we're currently sitting, I still see India as really good performing market. Now, in terms of U.S., I think we're looking forward to better performance in the second half, primarily because I think we're over the hurdle in terms of some of the negative shocks that may have come out in the Q2 earnings. For instance, regional banks. There was a lot of worry about regional banks. But they pretty much came out unscathed on average, and I think when you think about where the Fed is going, they may stop raising rates. We'll see in August, but that they may be in terms of rate hiking cycle. So in the meantime, I don't see any kind of weakness that would propel the economy into a hard landing. When I look at bank results, asset quality is fairly benign. It is lagging indicator, but when you're looking at very strong employment numbers, corporate earnings have been reporting very well so far. So I think we're pretty much set up for this rally to continue in the second half.
Okay, set up for the rally to continue in the second half, and what a rally it's been, right, Dean? You track the technicals of the market closely. So on the Nifty, it's been, what, a 10% rally in just 3 months. Do you have your sights set on higher levels in a shorter span of time? And what are the targets that you're looking at on the Nifty, say, over the next couple of months?
Yeah, I mean, we don't do forecasting as such, but we look at technicals very carefully. And right now, the sensex is holding up very well. Next support is a rising 21-day moving average, which is 1% away. So what I would say is, as long as the index can find support at that 21-day moving average, we're still go mode, right? And the next resistance is the recent high at 67,600 or so on the sensex. What I would say is, there's a lot of stocks that are performing well in India. But I think it's time for us to, kind of take a look at the technicals. And if a stock is trading, let's say 40 to 50% above its 200-day moving average, and you see a down day, perhaps that's your signal to start trimming. I would, take that as a funding source to look for stocks that are breaking out from early stage bases, and there are plenty of them out there. I would pay attention to that kind of signal. Don't be complacent and hang on to those stocks that are trading way above the 200-day moving average, because when they consolidate, they come down pretty hard.
All right. Hi, Dean. Morning. You want to name a couple of those stocks in the past? I think you've said Tata Motors is something that you've liked. You were looking at Reliance as well as Maruti. So stocks that you like and stocks where you've taken some money off the table.
Yeah, I think Tata Motors is the clear example. It's a bit extended, so perhaps it's time to trim a little bit. I think there are other stocks out there, such as Titan Company. You have IndiaMart. They're both on the retail side, and on the cap equipment side, you have Siemens, Thermax, SKF, Grindwall. So those are, fairly good names, just breaking out from early stage base. So those are the types of stocks that I would kind of take a look at the moment. Now, in the autos, if you like the auto sector, I think Ashok Leyland as well as UNO Minda, those are opportunities. And then on the technology side, perhaps Coforge.
Okay, Coforge, got that. Thanks a lot for joining in, Dean. Appreciate your thoughts as always. Let's slip into a quick break on that note. Plenty of stocks to talk about, so many result reactions. Our entire team will be with us in just a minute to take you through that.
Welcome back. Well, as promised, our team is standing by with a list of top stocks to watch out for this Tuesday morning. And what else but Maruti to hit it off? Sonia, I don't know what to ask you, whether to ask you about the numbers or the change with respect to the Gujarat plants. Maybe let's start with the numbers. How were they?
So the numbers were weak. I'm saying weak because there was a big margin miss. The margins were lower than what the street was estimating and lower than what they did last quarter as well. There are a couple of reasons for that. So 9.2% is what they delivered. 10.3% was the poll. So it's 130 basis points, which is the quarter-on-quarter fall that we've seen in the margins. It's hit by two things: higher employee costs, which the company said was a one-off. It generally happens in Q1 where their employee costs are higher. So 110 basis points jump over there quarter on quarter. There's also higher sales promotion expenses because of the new launches that Maruti had. So all this has hit their margins. But the other thing is the acquisition of Suzuki Motors' 100% stake in SMG, which is Suzuki Motor Gujarat. Now, earlier, if you remember, the deal was Maruti wanted to concentrate more on marketing, servicing of the products, and Suzuki had invested in, production, etc. So Maruti did not have to invest any money. They would concentrate on marketing and servicing. But now they'll acquire this entire stake and take over everything. So the company has said in their release that, this will bring in operational synergies in terms of production and supply chain management. It's also because a lot of things have changed in the last 9 years. So they'd rather do everything under one umbrella itself, taking on the production as well. Now, this would also mean that there will be some outgo in terms of cash. There will be EPS dilution and there could be ROC dilution as well. We don't know the details of that. The company will have a separate board meeting to decide what the contours are. But a couple of brokerages are a bit, cautious. Motilal Oswal has said that higher staff costs have led to an EBIT miss. The Gujarat plant to be acquired from the parent will definitely result in better production efficiency and agility in decision making, but it will also lead to an EPS cut of 4 to 5% and an ROC reduction of 90 basis points due to a cash payout. And similar is, the view that's coming from Nomura as well.
All right, Sonia, thanks a lot for that. Well, we'll also be joined by Mr. R.C. Bhargava, Chairman Maruti Suzuki, who will be joining in a short while from now to discuss the Gujarat plant news and also their Q1 performance. Let's move on to other stocks, though. Vivek joins us to tell us about Power Grid as well as IRB Infra. Morning, Vivek.
Well, good morning. Power Grid slightly soft quarter impacted by subdued commissioning trends. Along with the results, the management also declared a bonus issue. So you will be receiving 1 share for every 3 shares that you hold as far as Power Grid is concerned. Now, talking about the numbers, revenues largely flat on a year-on-year basis, coming in close to the 10,400 crore mark. On the back of lower costs, EBITDA jumped high by almost 3.5% and margins to improve by over 200 basis points. However, profitability was impacted, down almost 6%. Segmental revenues, largely flat, indicating, not much growth as far as the top line is concerned. Now, coming to IRB Infra, it's been a subdued quarter. We also have to keep in mind that Q1 of last year did have a one-off income that came in on the back of an arbitration claim that the company won. But despite that, when looking at the numbers, revenues down almost 15%, coming in close to the 1,634 crore mark. EBITDA, core EBITDA down 27%, margins coming in at 47% this time around versus 55% last time around, and profitability too impacted, lower by almost 63%. Expect a red in the stock. However, in terms of the order book, the company continues to hold a strong order book position and traffic trends continue to remain quite positive.
Okay, thanks for that. We will be joined by the management of IRB Infrastructure at 9:50 a.m. later today, so watch out for that. But a couple of stocks that I'm watching this morning, one of them is Bosch. I'm going with red over there because the numbers are a mixed bag. And there as well, there is a miss on the margin front. Revenue growth is strong, better than estimated at 17.5% year-on-year. The company says that they saw increased sales in the exhaust gas temperature components. It's basically used in pistons. So they saw increased sales in this EGT components, both in passenger cars and commercial vehicles, and that aided their top line. But it's the margins that I'm worried about. Margins are down 140 basis points year-on-year, coming in at 11.3% compared to 12.7% same time last year. And if you look at the trend of the last 4-5 quarters, the margins are at the lower end of the band now. So we need to understand from the management what went wrong. The other stock that I'm looking at is JBM Auto. Good numbers there, so I'm going with green. Revenue growth of 9.5%, margin growth of 250 basis points year-on-year, coming in at 12.2% versus 9.7%. Net profits are up 17% as well. And the board has approved raising up to 500 crores via issuance of securities. We'll, of course, await more details from the management on all of this, considering that JBM Auto generally tends to have lumpy quarters. This is a good quarter for them, so I'm going with green on that stuff.
Okay, all right, Sonia, thanks a lot for that. Well, let's hop across to Sonal. She's here to tell us about UPL, Oberoi Realty, as well as Petronet LNG. Morning, Sonal.
Good morning, Nigel. Let me start with UPL. After a weak set of numbers, conference call was important, where the commentary was not very positive. They said inventories at distributor level will normalize in coming quarters. However, prices are barely covering the raw material costs as well, and they expect prices to move up, but it's very difficult in current scenario to predict when that will happen. Due to lower demand, current prices are likely to persist in near term, so that's a negative. And competition from China is expected to be intense, something that has been a commentary from all the chemical players. For Petronet LNG, it was a good set. It beat our poll top down. Revenues were down 16% on a quarter-on-quarter basis, but EBITDA was up 25%. Margins were higher, around 350 basis points, leading to a profit growth of 29%. It was a volume-led growth this time. Nomura has a neutral rating with a target price of 260 rupees per share on the stock. They say Q1 EBITDA was above estimates, and lower spot LNG prices will keep the near-term outlook positive as well. On Oberoi Realty, going with red because their bookings were weak. Even their P&L is weak this time. The other businesses as well, be it the rental business or the hospitality business, their residential margins have come down by around 600 basis points. This is because of lower bookings and collections as well. Their rental revenues, those have also seen a decline. And if you look at the operating profit margins, they have seen an increase. However, the hospitality revenues and margins have also seen a decline this time around. So going with red on this one.
Okay, so some caution for Oberoi Realty. Thank you for that, Sonal. Let's go across to Surabhi to find out how KEI Industries fared in the quarter gone by. Surabhi?
Thanks so much for that. So KEI, it was a mixed set. Now revenues were largely in line with expectations, but it was a miss on the margins front. Revenues were up 14% on a year-on-year basis. Street was working with anywhere between 13 to 14%. The gross profit margins were slightly higher by 30 basis points, came in at 25.2%. EBITDA was up 12% on a year-on-year basis, but the margins were down 20 basis points, came in at 10% versus 10.2%, and the street was working with a number of nearly 11%. So miss on the margin front. The revenues were largely led by growth in the housing wire business, but the miss on the margin, which is why I'm going with a red for KEI.
Okay, thanks a lot for that. Miss on the margins, hence a red for KEI. ONeill Gupta, the Chairman and Managing Director at KGI Industries, will be with us at sharp 9:30 a.m. So you'd want to keep your date with him. Let's go across to Abhishek now. He's tracking DLF this morning. Abhishek, over to you.
Well, Sonia, sources tell CNBC-TV18 that DLF's promoter group is likely to sell part of the stake today. So about 2.16 crore shares, which forms about 0.87% of the equity of the company, may come in block window today. So deal size is about 1,086 crore in terms of INR, and in terms of USD dollar, it's about 132 million. The offer price is at 503 per share, which is a discount of a little more than 3% to yesterday's closing price. Access Cap is the sole broker over there. Back to you.
All right, Abhishek, but you stay with us. We want to know something about some brokerages as well. For the time being, let's do a quick recap of all the top stocks that we just discussed. Stocks with positive news flow include JBM Auto, Petronet as well as DLF. While stocks with negative news flow include Maruti, Power Grid, IRB Infra, Bosch, UPL, Oberoi Realty as well as KEI Industries. But Abhishek's hung on because he wants to tell us about some brokerage notes that he's read this morning. Abhishek?
Well, Nigel, to begin with, Citi has written on UPL. They have a buy recommendation. However, the target price has been cut to 800 per share. They have cut the FY24 and 25 EBITDA estimate anywhere by 15% to 12% to factor in the Q1 hit that the company had. Even Jefferies has a buy recommendation on the stock, and they have cut the target price to 800 per share. They have cut FY25 to 26 EPS anywhere between 9% to 10%, and FY24 cuts are even sharper than 9 to 10% that they have cut for FY25 and 26. Citi has written on Maruti. They have a buy recommendation. Target price has been cut to 13,200 per share. They say that Q1 is below estimate due to higher costs that the company had seen, despite the fact that they had better realization over there. Jefferies has written on GAIL. Target price remains the same at 105 per share. However, the recommendation has been downgraded to underperform from hold that they had earlier. They say that the risk reward has turned adverse given the fact that the stock has rallied 15% in July, with the stock now trading near one standard deviation on a forward EV to EBITDA estimate. Back to you.
Okay, all right, got that. Thanks for the details there on the brokerages, Abhishek. With that, let's turn the spotlight on commodities. Manisha Gupta is joining in with the latest. Manisha, good morning.
Morning, Sylvie. Thank you so much for that. I'll start with the crude oil prices, where we are trading at a 3-month highs, and 16% of gains come in for the month of July. So whether it is about the U.S. fuel demand, Saudi Arabia and the OPEC allies output cuts for the month of August and September already put out, or the fact that the Goldman Sachs also has upped the 2023 global demand forecast, everything seems to be supporting crude oil prices right now. What the street will watch out for now is the 4th August OPEC and allies meeting. That is where you could be looking at further guidance coming in from the major producers of the crude oil. But it's not just crude. The metal prices also have continued to surge up. You have copper prices, which are also trading at a 3-month high. So for the month of July, you've seen most of the metals actually gain up on the higher side. So even as Chinese manufacturing has shrunk for a 4th month in the month of July, we've seen copper prices gain up by 5%. Anything like aluminum, zinc, nickel also gained up by 6 to 9% for the month of July, with the street expecting that for the month of August, you could be looking at the China stimulus going through, which could further support prices from here.
Okay, all right, Manisha, thanks a lot for that. Well, so, before we get to that chat with the Maruti management, actually, that's a clear negative, right? Because if they do it as the book value, the last reported book value is around 12,700 crores odd. If they do it anywhere in that vicinity, there's going to be cash outgo. And as of the last year, Maruti earned, 5% as, interest on their cash in their books. Yeah. So, just roughly if you take it, 12,000 crores moves out, approximately 12,000 crores. We don't know the actual number. There'll be cash outgo and they're not going to earn anything incremental. Maruti's cash balance was nearly around 49,000 crores as of 31st of March. So, the street will not like it one bit, but I think it's up to the, they'll have to pass it by the minority shareholders. So, majority of the minority will have to pass through. And let's see whether or not they stand up. Because otherwise, there'll have to be something more that they'll have to clarify to make it viable for the shareholders. As of now, it's not making much sense. And also, the Maruti stock has re-rated in the last few years, right? From mid-teens, it's gone up to more than 20, 25 times on. And suddenly this comes out of the blue. So I think the stock will pull back quite a bit.
But Nigel, cash is one thing. And as long as you can justify the use of that cash very clearly and very convincingly to your shareholders, I think the market can take that. But I guess that's the tough ask for the management to explain why after 8 years, suddenly they want to take ownership of the plant back from the parents. So I think it'll be an interesting chat for sure.
Absolutely. And in fact, we have the management joining us now. So just to give you a sense of what things have, what has transpired, it was a mixed bag in the first quarter. So profit and revenues beat expectations, but margins fell short because of higher employee costs. But they've also, as we were just discussing, terminated that contract manufacturing pact with Suzuki in Gujarat. So now they will acquire SMG, Suzuki Motor Gujarat, from the Japanese parent. Let's find out more about this. Mr. Bhargav, the chairman of Maruti Suzuki, is with us. Mr. Bhargav, on the transaction first, just want to understand, will this transaction be EPS accretive? Because there will definitely be a cash outgo. So just trying to understand what the contours would look like and what is the rationale behind this sudden change in plan?
You know the background of SMG. In 2014, Suzuki gave us this offer that they would put in all the money as equity to set up the production facilities which we were originally planning to do so that we would not have to make any investment there. And then they would make the cars and supply them to us under contract manufacturing agreement at cost. And it seemed to a lot of people to be a transaction which is too good to be true, but actually it was in the interest of both parties. And as a result of which, till now, we have, as Maruti, earned an extra interest income from not investing of something over 5,000 crores. And the production has taken place smoothly. We didn't have to put in any resources. Everything was going fine. But in these 9 years, Sonia, a lot of things have changed. The market for Maruti has become much bigger. And we are now already at 2 million. And as you know, we are in the process of growing further and expect to reach 4 million by 2030. The number of models which we are making will keep growing with the addition of more SUVs, with the addition of EVs, and that model number could be anything 26, 27, 28, I don't know, some number like that.
Okay, you also mentioned to me that this will minimize, you will try and minimize the losses to both entities. So there's definitely going to be some loss. And of course, you'll tell us that when you have that board meeting next with Suzuki Motors. But is it fair to assume that at some point this deal will become EPS accretive for you? And I also want to understand, would this mean there's any change in the capex plan for both entities?
The capex plan doesn't change at all. The costing will not change at all. The production volumes will not change unless in some way we can add a little more capacity to the plant in the SMG. Those are little things which we are doing in all our plants, so that's not an important part of it. How we will buy the shares, as we have said, we have yet to discuss in another board meeting. And we will then discuss the modalities of buying the shares from SMC. And do that in a manner which will, as I said, be in the most beneficial manner.
Mr. Bhargava, good morning, sir. But we just wanted a little more clarity on the thought process. So what has changed? Yes, a lot of time has gone by in the last 7-8 years. Earlier, the rationale that Maruti gave was that the Indian entity will not own this plant. It will focus more on marketing and servicing. And you'd actually benefit from the parent, Suzuki, making that big investment in production. So what has changed now to turn this on its head pretty much 180 degrees?
The ability to manage this kind of volume, which we will now have, and we've already reached, actually, we've reached 2 million, 2.2 million. Without reorganizing Maruti is not going to remain possible. You know, nobody in the world is doing this kind of volume under a single company with a single management. And the complication is compounded by the fact that the number of types of technologies are becoming much larger than they ever were. So with that situation, the whole problem of management, coordination, shifting production, changing volume becomes much more difficult if you have two managements dealing with it. So this is actually one stage. I believe that once we have this part of it completed, and we are on our way towards completing, at least starting the production at Kharkhoda, and then we've also picked the next site for expansion and started working there. There will be further reorganizations happening in Maruti. We can't go to 3 million, 4 million with this organization.
Okay, you felt the need to change because you are looking to produce a lot more, and then you want to take ownership of all your plants. Got that. Sir, how are shareholders viewing this? Have you had any conversations of this new change? And also, will there be any, in the interim till you get this done, will there be any change in the estimation of, let's say, the sales or the volumes that you're looking to do right now?
The shareholders should feel reassured that this acquisition of SMG will immediately not make any difference in terms of the production volumes, sale volumes, or the cost of the car. He should also feel reassured that because the objective of this is to increase the efficiencies of all operations, over a period of time, this merger will actually make the organization capable of performing at a higher level of efficiency. And that will be to the shareholders' gain. He should also feel that if we reorganize Maruti to more effectively deal with a larger number of technologies and a larger number of models, larger export volumes, and go up to 4 million production, all of that will be to the shareholders' benefit. If we remained unchanged and we fail to recognize the changes that are happening in the market and in the whole automobile situation, then I think the shareholder would, after some time, have realized that the whole Maruti inability to change is actually hurting them.
Okay, I think the shareholder concern is that if the termination of this agreement provides synergy benefits, then why was this agreement done in the first place, right? So that change of stance is something that perhaps could spook the street. But sir, enough about that. Let's talk about the industry growth as well. Earlier, you had guided for a 5 to 7% volume growth for the industry in FY24. Given what you've seen so far, there's no recovery in the small car segment. Any change in that guidance at all?
No, I think we're on track. We have grown compared to last year by 6%. And this was despite some loss of production because of the semiconductor thing, 28,000 cars in the first quarter. We expect the semiconductor situation to only get better as we go along in the rest of the year. So that one constraint which has been there for some time now will go away. And the new production volumes, which we expect because of that, should help us grow a little bit better than 6%.
Okay, so you'll grow better than 6% in FY24. That's still, single-digit growth that you're looking at. But what about the margin fall that we've seen quarter on quarter? You of course mentioned in your press release that it's because of higher employee costs. But do you see more pressure in the quarters to come?
I don't know about margins, but in the first quarter of the year, the employee expenses always go up. If you compare from last year to this year, it's a 0.1% difference. And if you compare with the previous quarter, it's a 1% difference. And that is because the wage increase, salary increases happen in the beginning of the year. The year goes on, and that addition, lump sum addition which comes along doesn't happen throughout. And as volumes increase over the year, the employee costs come down.
Mr. Bhargav, thank you so much for taking the time out, speaking to CNBC TV18 and clarifying all our questions with regards to the SMG acquisition, what it means for shareholders, as well as the margin pressure that the company is seeing. Appreciate your time here. Let's slip into a quick break, but what do you do with a stock like Maruti? We'll ask Gurmeet Chadda, Managing Partner and CIO at Complete Circle Consultants, in just a while. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. You're on CNBC TV18. Well, as promised, Gurmeet Chadda, Managing Partner and CIO at Complete Circle, joins us on the show. Hi, Gurmeet. Good morning. Well, what do you make of the overnight news on Maruti? The numbers a little bit subdued. And this buying out the Gujarat plant as well, it's not going to go down with shareholders. How do you approach the stock from here on?
Nigel, surprising, because they had earlier stated asset-light model and they made a case for how this would help in terms of, the contract manufacturing at the SMG plant. It's a little surprising to me, and we need to see whether it will be all cash or equity issuance, because if it's all cash, then it's close to about 13,000 crores, which could mean, earnings cut and also possibly some impact on even ROC by a few basis points. We probably need to calculate that. And if it's equity issuance, then the dilution could be between 4 to 5%. Depending on what price they take, in the board meeting. This follows after some flip-flop even on the royalty payments. There's some confusion, they wanted in terms of shifting to rupee payment and, bringing the royalty down. In fact, last year it could be close to like 4,200 crores. And I think the sector probably seeing some recovery after 5 years of tough period, right? I was seeing the volumes actually, we barely exceeded 2017-18 volumes in four-wheelers this year. right? And so I actually don't get it, although I don't hold the stock. And there have been reasons for non-performance over the last 4-5 years. This definitely doesn't help. I don't think the numbers were that bad. I think there was volume growth, the realizations went up. After a long time, I saw the adjusted EBITDA margin at about 10%. So I don't think the numbers were that bad. But I think this news actually should, in my view, is slightly negative.
Okay, it's slightly negative. So, what is your advice to shareholders? Because clearly, Maruti believes, and from the chat we had at RC Bhargav, that there's a larger game here, right? They want to take everything control of all the production as well, because they believe that they're going to go from 2 to 4 million. So, after that initial cash outgo, that initial hit on the ROE, do you think the stock could bounce back? And what is your advice to investors who hold the stock?
I'm not sure, Sonia. I think if you see the market share also, it's down to 43% from almost 50%, while the sedan market share is still 68. I think the SUV launch pipeline to me has been still not as what the market would have liked. Even the Jimny, I think the response is not as exciting as probably what we would have wanted. We'll probably have to see. I'm just talking of the first cut, my talks with some of the auto dealers. Even M&M, I don't know. I mean, even the RBL thing, I think the lack of communication is slightly surprising. So, two events, on I would not say strictly capital allocation, but raising again concerns on capital allocation, which I think has been an issue, with this. So I'm actually a little surprised on the timing bit of it. I think the communication probably should be more clear. So between the three, M&M, obviously there is valuation comfort, and I mean, maybe there is a larger plan of getting a scheduled commercial banking license. We don't know that. The buzz in the street is that RBL could be a two-way fight, for example, in terms of bids for it. But I think between the three, probably Tata Motors looks the best right now. All cylinders firing, JLR doing very well. Commercial vehicles picking up, passenger vehicles, they are doing well. There's a lead they've taken an early lead on the EV portfolio, debt reduction. So I think all in terms of the relative attractiveness, I think Tamo looks better. M&M is also good purely from a valuation point of view, provided they give more clarity on the RBL stake.
Okay, Tata Motors looks better on a relative valuation, got that, and M&M as well. By the way, all auto sales come out later today, so we'll talk more about that in greater detail. Gurmeet, stay on. We'll take a quick break. On the other side, Anuj will be joining in for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts.
Welcome back. So what will the bulls do? Will they manage to prevail once again? Today we have Anuj in the house with his reading of the morning setup. Anuj, morning. So how's it looking?
Morning, Surbhi, Sonia, Nigel. Well, you know what? The setup is perfect, actually. It can't be more perfect than this in terms of how you approach trade from here. Look at what the Nifty low and close has been for last 2 days, and I'll explain why it's important. On July 28, the Nifty low was 19,563, and yesterday's low was just 34 points above that at 19,597. And that number from 563, we rallied to 19,646. And yesterday, after defending 19,600, the Nifty had a 150-point rally, and we closed at 19,753. Why is this important? Because of two reasons. First, the Nifty respected the first day low of the series. That is a very important factor when you take a series view. Also, it was a 20-day exponential moving average. So for traders, the trade is very simple. If you've been long, that becomes your stop loss, 19,563, the first day low. But also keep in mind, the market otherwise anyway has been fine. The mid-cap index has been hitting new high even when the Nifty has been lagging behind for last few days. Yesterday also, the mid-cap index hit fresh all-time high. And as long as the market breadth is fine, I think there's nothing wrong with the market. What we need is for Nifty, a couple of big stocks to fire. You know, something like an HDFC Bank perhaps, or Reliance, or a TCS. One of these stocks to just put its hand up and say, okay, I'm taking Nifty back towards the 20,000 mark. One number that you need to keep an eye on, and I'll come to the chart later, is the FI long positioning. That's down suddenly to 51%. And they've also started to sell in the cash market. In fact, let's have those numbers. First, let's have the bar graph. Now, these are the numbers, you know, for last 3 days. On Thursday, you could have given benefit of doubt because of the expiry. But the next 2 days have also been on the sell side. And now the number that I track, or the picture that I track very carefully. Now, this is the FI net longs in index futures. Now, this almost hit a peak of 1 lakh contract plus. It's now come down to almost neutral territory because we are now, as I said, 51% long. Now, look at this line. This line is important because the big rally happened once this positioning crossed this line. And now you come back to this line. So in that sense, it's important to take support here. Do the FIs know something that we don't in terms of their selling? But that's, you know, only to nitpick. Otherwise, the setup is quite strong.
Okay, all right. Thanks a lot for that, Anuj. Well, let's move on. We have Mitesh Thakkar as well as Sudarshan Sukhani who join us on the show. Good morning, gentlemen. Sudarshan, you go first. How do you approach trade? Yesterday, we had a good rally from the lows. What's your approach, given that the GIFT Nifty is suggesting a 50-point gap up?
Yeah, good morning. Well, yesterday I had suggested going long on 2 different occasions. One, if we get an early morning dip, or otherwise, if we get an afternoon dip. We got an early morning dip, and that was the perfect place to go long, and there was a 150-point rally from that point onwards. My point really is that every day is not a trading day, but some days we are in the flow. And today, the chances are that we will see a continuation of that up move. So for those traders who have trades from yesterday, they've carried forward, you take partial profits and stay with the rest of your position. The profit-taking zone is somewhere around 19,850 to 19,900. So till then, part of your position should be maintained on the long side. For those who do not have a position, you then have to wait for a minor dip, intraday dip, and then go and buy.
Okay, all right. Well, Mitesh is also with us. Mitesh, how are you feeling in general? This has been a really strong market, right? No two ways about that. But is there more upside in store today? And while you're at it, tell us about individual stocks as well.
So I think, this is a market which has done well, but my sense is that I think, broadly, this is still a market which is consolidating. And therefore, I think, in the next few days, I think the market would be slightly choppy, but going through what typically we call as a time-wise kind of correction. So I think that's a fair enough kind of a market. I think, you might have this kind of scenario for next few days, especially after the kind of rally which we've had for the last many months. My sense is that the initial feeling is that the range would be, between about 19,500, 550 on the downside to about 19,850, 900 on the upside. And that's the kind of move which we are looking at. So as long as I think this range remains, I think the market will be fine. And after a few days of consolidation, I do eventually expect that the index will come back into some kind of a positive vibe. So with this kind of a view, I think we're trading with more stochastic bias, but trying to be biased and declines on the index.
Okay, that's the index call from both of our tech experts. Gentlemen, good morning. Mitesh, what about stocks? What do you have your eye on today?
Morning, Surabhi. I have all buy calls. Maruti is something which managed to get past an important intraday pivot, so could see a trading rally to about 99.50 odd levels. Buy here with a stop at 97.70. Hindalco is a buy with a stop at 455 for targets of 480. It's been a buy earlier as well. Now I think the stock should achieve its medium-term targets. Power Grid is a buy with a stop at 260 for targets of 272. And Balkrishna Tyres, disclaimer that I have some futures positions over here, so there's vested interest. That's a buy with a stop at 2,500 for targets of 2,630.
And Sudarshan, how about you?
Well, Bajaj Auto is a buying opportunity. It recorded the highest ever closing high, not the high, but the closing high, and that's good enough. It also comes out of a long 3-week consolidation, stop under 48.50. HDFC Life is my only short. It's an intraday short with a stop above 655. It has a very clumsy chart suggesting lower levels are coming. IndusInd Bank has come in my list earlier many times. It's one bank, mid-cap bank, where buying is justified for short-term traders as well as for position investors. Even now, stop under 1380. And finally, Polycab, which again had a massive rally and recorded new highs yesterday, is still a buying opportunity. Put a stop under 46.10 and go long.
Okay, all right. Thanks a lot for that. Let's take a quick commercial break. On the other side, we have the pre-opening rates. We'll also have Samir Dheer, the MD and CEO at Sonata Software, to discuss the company's performance for the quarter gone by. Do stay tuned in. Welcome back. Well, Manoj Muralidharan, the Vice President Derivatives at Religare Broking, joins us now to give us his view on the markets. Manoj, thanks a lot for being with us. You know, the market has had, of course, a great run, but do you think that there is a bit of a pause on the cards now? And what are the individual stocks that you're looking at today?
Good morning, Sonia. Sonia, I was listening to Anuj as well. That's a wonderful piece of quantitative data that is mentioning. So the good part is FIs usually when they start the series or when they did last month, they were at a good 66% long and they started this series at 59. So yes, there is a 5 to 6% more of hedging into the index, which we might say that. Now, having said this, even when we started this August series, we have started with a 25 lakhs greater amount of positioning than what we did in July. So almost 1 crore 17 odd lakhs is where we started this series. It was only the bank nifty which was shying away by a good 3 to 5 lakhs if we compare month on month. But yesterday, I guess almost 7.5% open interest has been added, and every time if you see the bank nifty helps the nifty, the trend has got strength. So we believe that bank nifty at least 46,400 to 500 is in the offing, and the stock specific, I believe that ICICI Bank at 1015 to 1018 should be the a major leader along with HDFC Bank. Even for the Nifty now, as we were mentioning, 19,900 might be an intraday resistance, but then again, this broad-based rally positional-wise has maybe a 20,000 or 20,100 in the offing. So buy on dips at 19,800 today on the futures, stop loss of 750 and a target of 19,900 should be the intraday trade for the day.
Okay, I got that. Manoj, do share your picks. By the way, just want to point out that in the pre-open, Maruti were getting the first reaction to those numbers and the Gujarat plant issue. In the pre-open, Maruti is down about 3.5% as we speak. The Nifty is flat. More on Maruti in just a bit. But Manoj, specific stock ideas?
Shulvi, I guess this series of August, pharma and metal should get the share, and we are seeing a good market-wide participation. Market-wide is nothing but your entire percentage to the net derivative stock futures that we have. So we believe Tata Steel has more leg on the upside. So we recommend buying that at 124, stop loss of 120 and a target of 132. And the second pick would be on ICICI Bank. 996 is where we recommend buying that at stop loss of 986. And 1015 to 1018 should be the positional target in August series for ICICI Bank.
Okay, all right. Manoj, thanks a lot for that. Well, Gurmeet Chadha is still with us, so let's speak to him about a couple of things. Gurmeet, from the entire earnings season that you've seen so far, what has the standout performer been for you? I know one of them has been Polycab, so I'm sure you're going to mention that as well. But, you know, X of that, what are the other standout gainers that you've seen?
So I think, Sonia, despite, so obviously building material space continues to do well. Not only Polycab, we've even seen, except for the, the MDF guys, where, there was margin issue, most building materials have done well. And I think banks and NBFC stood out. I think there was a lot of concern in market on credit growth peaking out, NIMs peaking out, etc. I personally think we are in a very good structurally credit cycle. It will obviously moderate, not sustain at, but even June fortnight was about 16%. So I think this credit creation, which is happening in newer segments and beyond the top tier 1, tier 2 towns is something I think which is more long term. So stood out. And despite that, the two strongest private banks are still not done too well. Kotak, probably the profits have doubled in 3.5 years and price is what it is. So I think, so there is still opportunity. The valuations are still reasonable. Some of the small finance banks continue to do well. We like Equitas, a few others. Some of the small mid-cap banks delivered very well. IDFC First had a very good set of numbers. I was very happy with the, the CASA, the credit cost, all metrics. They're guiding now for 1.5% ROA, 15% ROE. Stock making a new high. Federal Bank looks very interestingly positioned, very, very reasonable on valuations. Did a QIP. There is some reopening, value unlocking through FedFina. Their NBFC, infusion of funds by IFC, and very good portfolio. In fact, the unsecured portfolio is just 4%, so very good mix there. So that's then one segment which we like, and I think pharma is picking up. I think that's one sector. I think it's a close watch for us. I think we've seen some of the CDMO names fly, including Newland, which we have discussed multiple times in our interaction, and Syngene. I think others will follow. A lot of molecules are in stage 3, and you will see a lot of validations going forward. So even healthcare to me looks pretty exciting.
Okay, some interesting ideas there, Gurmeet. Thank you for all of them. Great having you on the show as always. You have a good day, and we look forward to connecting again. Well, speaking of results, let's focus on one more. Sonata Software came out with what looked like a good set, and it was a good quarter for the company. Strong performance coming in from the IT services part of the business. Sonata also registered 2 large deal wins in the last quarter. Samir Dheer, MD and CEO of the company, is with us now for a quick conversation. Samir, good morning. Thank you for joining in. I think investors will take this with both hands in an environment where a lot of companies are showing lack of growth, compression in growth. You've managed a 17% if we count in the Quant acquisition, and I think just 4% constant currency growth in organic terms. So tell us, what's the visibility that you have for the rest of the year? Can you keep sustaining this run rate? What are clients telling you? Did you face any deferrals or any cancellations, any hesitation at all? Because a lot of your peers have been suffering from that.
Thank you. And I think we are well pleased with the performance our teams have delivered. 17.5% sequential growth and 36% Y-on-Y growth is a pretty good result that we could deliver. Even on an organic basis, 4% sequential, I think, is a very good sign. The deal momentum continues to be pretty strong. As you know, in the last 3-4 quarters, consistently we have clocked 2 or 3 deals every quarter, large deals at that. So I think that's really helping us sustain the momentum. Clearly, the market environment is tough right now. There's no questions about it. Specifically for Sonata, we have seen some softness in the high-tech segment. But beyond that one segment, in general, the market environment has held up for us. Our large deals momentum that we've been building for the last 3-4 quarters is beginning to now bear fruit for us, which is, I think, what is reflecting here. And if you look forward, I think our expectation is that we'll continue to be in the top quartile performance of the industry. And this is what we have been doing for the last 2-3 quarters. We expect to be in the top 3-4 players in the industry and keep delivering that. So that's really our expectation. The pipeline is building up nicely. The order book for the quarter was the book to bill was about 1.2. And the large deal pipeline is looking pretty healthy. So still pretty optimistic about the future. And we believe that we can be in the top quartile performer even go forward.
So you're not seeing any project cancellations, any slowdowns at the moment, right?
We have seen some decisioning delays in pockets. Like I said, in the high-tech sector, we have seen decision delays. I wouldn't call them cancellations. The thing that was supposed to start in March got pushed to April and things of that nature. But I wouldn't say cancellation per se, but that too also very specific to high-tech industry.
Got it. So there's a decision delays specific to the high-tech industry. Can you share some numbers with us? You have a target of $1.5 billion of revenues in the next 3 to 4 years. How did you come to that number, and what would this mean in terms of a breakup? How much will come in from the inorganic route? How much through organic? And what are you looking at in the next 1 to 2 years itself?
Yeah, so I think when we put out the vision about a year back to double the company and get to about 500 million run rate in about 3 to 4 years' time, I think the objective was to be one of the fastest growing company in the market. And I think we're well on our path to do that. Clearly, we have demonstrated for the last 4 quarters consecutively that we have won large deals. We have delivered on the top quartile performance. So we feel we're on that path. And clearly, it's a combination of many things. A single most factor, I think, is our differentiation in the modernization engineering, which is a message which is resonating very well with the market right now. There isn't a client conversation which is not diving deep into modernizing their cloud platforms, their data platforms, their customer-facing platforms. And I think that's really building the momentum for us.
All right, Mr. Dheer, we're a little short on time, but a final question before we let you go. The organic growth has been around 4% on a sequential basis. Do you expect to maintain this? This is on the IT services business. And also margins have improved a wee bit, but they're still short of that 27, 28% that we saw earlier on the IT services business. What's the trajectory out there as well?
So it's a great question. I think when we articulated to get to 500 million, we had said that our EBITDA will be in the low 20s over a period of time. And I think we have made significant investment in the business, which is really helping us win the market, get a market share right now. And we expect to be in low 20s EBITDA even go forward. I think that's the trajectory we have been on, and the investment that we made in the business, whether it's in the sales organization, whether it's in the partner organization, the technology organization, I think they're all beginning to bear fruit for us. And that's what is really helping us out at this point in time.
Sure. Got that, Mr. Dheer. Thank you very much for joining in. Good luck for the rest of the year. That's Sonata Software. By the way, pull up the KEI stock in pre-open. It's showing a very sharp downtick. It's down about 5%. Numbers weren't that bad, you'd have to say. I mean, there was the minor growth that was coming in. Actually, revenue is up 14% year on year. EBITDA has grown. Margins are constant at around 10%. So why the disappointment? My guess would be because Polycab simply blew the lights out in terms of an outperformance, and the stock has been on an overdrive. So comparatively, this is probably more standard in terms of a performance. Market wants more. Okay, let's get to the 9-10 calls. So Darshan, what stock would you go with?
I would go with Bajaj Auto. Bajaj Auto is a buying opportunity with a stop under 48.50.
Okay, Bajaj Auto. By the way, Escorts numbers are out and not bad actually. The domestic sales for Escorts in the month of July has gone up 9.7% year on year, coming in at 5,161 units. Exports is under a lot of pressure, but the domestic market is the main one for them. And they have positive commentary. They say that we expect retail demand to pick up well in the upcoming festive months starting September, and the monsoon has progressed well too during the last 2 months. So good numbers coming in from Escorts this month. But Nitesh, what would the big call be at 9-10?
So I go with the buy call or the long call on Balkrishna tires. Look for tires for 2630 and a stop at 2500 is more tiring.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's hop across to Sonal Shi joining us to tell us about UPL. Sonal?
Well, yes, it was a very weak set that we saw from UPL, and the commentary is not very positive as well. The management does indicate that inventories at distributor level will normalize in coming quarters. However, prices are barely covering the raw material costs right now. They expect prices to move up, but it is very difficult to ascertain when that will happen because the demand is still very weak. Due to lower demand, current prices are likely to persist in the near term as well. They say competition from China, that is something that is expected to be very intense going forward. So the working capital also will be stretched in quarter 2 and quarter 3. They will see some recovery or some improvement in working capital only in quarter 4. Restocking in the US markets is expected in quarter 3 and quarter 4. So second half is when they expect at least demand to pick up for the company as well. Brokerages, they have cut their target prices and estimates on the stock. Citi cut the price to 800. They have cut their EBITDA estimates by 15 and 12% for the next 2 financial years. Jefferies has also cut the target price. Sales were impacted by a pressure on volumes, which were down 9%. Prices were down 10%. It was led by price competition from China, erratic Indian monsoons, channel restocking, product bans in Europe as well. So a number of reasons, and that's why they've cut the EPS estimates by 9 to 10%, and FY24 cuts are even sharper. So the stock is on our radar today.
Okay, got that. So UPL on our radar. By the way, the targets have been lowered to 800. Stock is way below. Stock is at 620 right now. That is UPL for you. Sonal, what about GAIL? Lots of bull versus bear arguments here.
Well, yes, GAIL reported numbers during market hours yesterday. It was a slight miss versus the CNBC-TV18 poll, but the numbers were not so bad. But the street is divided. In the bull case, we have Morgan Stanley, where they have an overweight rating with a target price of 139. There was strong gas transmission volume growth, and this is the main business of the company. Improvement in petrochemicals, though petrochemicals did report a loss this time around. There's positive guidance, however, across all the divisions. This points to upside risk of street estimates after nearly a year of challenges that the company saw. As gas costs fall ahead by at least a fifth and pipeline tariffs rise, upside remains for the stock, according to Morgan Stanley. Nuvama, in fact, has gone ahead. They've hiked their EBITDA by 3% and they have a target price of 122. They call GAIL a diversified play on India's gas consumption, and growth will be driven again by their transmission business and volume growth and higher petchem capacity as well. However, some risks, that is the low utilization of pipeline and weak petchem, that will remain key challenges. In terms of the bear case, we have Jefferies, which has downgraded the stock to an underperformed target price of 105. Management sounded optimistic on transaction volume outlook. However, higher gas costs will limit EBITDA upside in FY24, and risk reward now has turned adverse after 15% rally that we have seen. JP Morgan also has a neutral rating with a target price of 115. They believe stock rally is driven by the hike in Brent crude prices, but they will be volatile, so it will be important to track for GAIL.
All right, thanks a lot for that. We're just heading into the market opening now, so brace yourself for that. Looks like it's going to be a positive opening, no two ways about that. But whether we build on to those gains, time will tell. For now, the 19,780 mark is something that's holding, and it could be a 30-point gain at the start. Couple of stocks to look at. Titan, ahead of its numbers, is up about 0.6%. In fact, a lot of the rural plays, the consumption-related plays, whether it's Hero MotoCorp, Britannia, are all doing well. Pharma could make a comeback today yet again. Yesterday, there was a little bit of profit-taking there, so Divi's Labs up about 0.5%. And some of the technology names as well look like they could start in the green. On the downside, though, Maruti Suzuki, there is a both result reaction and that SMG acquisition reaction on the downside, but it's nothing alarming. It's about restricting itself to about a 0.5% cut on the Maruti Suzuki stock. So there we have it. The first tick on the index in the green right now, so 30 points higher on the Nifty. The sensex is up about 100 odd points. As we were mentioning, the market breadth is pretty strong actually. More than 1,700 stocks on the advancing side versus less than 300 on declining. You have metal names that are topping the charts this morning. So JSW Steel is up about 1%, biggest Nifty gainer. Hindalco is up 0.7%. Eicher Motors also comes out with its numbers later this week. Ahead of that, the stock is up about 0.5%. Also, auto sales come out today, so we'll keep tracking that closely for you. Eicher, Hero, Tata Motors all in the green right now. Perhaps some relief on auto sales. Bharti Airtel also comes out with its numbers this week, so 0.5% higher on that one. And a couple of others like ICICI Bank also providing some support to the bulls. By the way, the market is now almost veering towards the red line. Maruti is your big loser, down about one. Not a big loser, I mean, it's a 1% cut. But yes, it is in the red, post the numbers as well as the SMG acquisition. Bajaj Auto is down about 0.5%. Power Grid down 3% right now, while ONGC is down over 1%. Couple of other names, M&M, Nestle, SBI Life and Cipla are also trending in the red as we speak. But otherwise, very, very quiet opening. Of course, a lot of result reactions in the broader market.
Well, that's right. So, Power Grid actually is the one that's pulled back on large volumes. So that's one of the biggest losers, down close to around 3% or thereabouts. In the broader markets, well, a couple of stocks deserve special mention. KGI Industries, the growth has been lower than what they appear. So remember when you had Polycab and the likes that came out with a set of numbers, KGI Industries had already rallied. So those numbers go down as disappointing. That stock's under some pressure. Bandhan Bank, the stock's up close to around 2% for starters. On the flip side, you have a couple of losers as well. Oberoi Realty, well, that's down close to around 2.5% in reaction to its numbers. And you have DLF, the promoter looking to sell close to around 0.9%, as my colleague Abhishek told us. So that one is down close to around 1.8%. And as Scott Sonia said, the number's pretty good. But for the time being, at least, it's pulling back a little bit. Remember, the stock has had a big run so far, but it's down close to around 1.5%. Flattish start, maybe closer to around 19,800 odd. Some money being taken off the table after the kind of run that we saw in yesterday's session. So, what else?
Well, I was just looking at Power Grid. That's a clear result disappointment that's playing out. And Power Grid, remember, had a very smart rally. Friday and Monday were big days for Power Grid. And now the numbers have come in and they're really lackluster. The other one is ONGC. The reason ONGC is down is that the windfall tax on crude has been hiked, and it's been hiked big time. From 1,600, the tax has been moved up all the way to 4,250. And there's a reaction coming on the stock over there. Maruti is struggling a bit, 1.5% down on that one. So those are the major newsmakers of the morning. Beyond that, the broader market is seeing small gains. Ujjivan Small Finance Bank is still running from yesterday. Some of the trades from yesterday, like even an IRFC, for instance, that's up and about. Bandhan Bank is seeing some green. These are the major reactions. But HD Infra is one more, which is a result which the market's reacting to quite well.
Also Bajaj Auto, the numbers are quite weak. I mean, they're actually lower than what the street was estimating. And despite the management saying that from July exports will improve, exports are still under a lot of pressure. The total exports have gone down almost 20% year on year, coming in at 1.4 lakh units. So I think, that is a pressure pocket that the market is seeing right now. Not just Bajaj Auto, which is the first of the two-wheeler numbers, but all the other auto stocks are also now sort of veering into the red. But gives us, some, time to just sort of get Tahir Badshah into the conversation as well. He's Chief Investment Officer at Invesco Mutual Fund. And, Tahir has had a very strong grip on the auto sector. He's invested in a lot of these auto stocks in the past, even in his previous work with Motilal Oswal. So, Tahir, I wanted your thoughts on what's happening here. There is a sort of disparate performance, of course, on one hand, but on the other hand, there's just no recovery. Whether you talk about, Maruti and their lower end segment, or you talk about Bajaj Auto and exports, even with Hero, what do you do with this space? Because there's been a good rally here.
Yeah, hi, morning, Sonia. So I'd like to think that, the conditions, at least for a recovery, are probably setting in. And, consumption, of course, has been on a weaker wicket overall, not just two-wheelers, but in general. Besides which, two-wheelers and some of the other auto names do cater to some of the lower-end segments of the market, which also have probably been under pressure for quite some time. But I think with the clouds clearing out there and probably, the monsoon also now a lot better than what it was, I think the rural sentiments are probably likely to perk up. And many of these are actually levered to that segment, as we know, to that side of the market, as we know. So I would like to think that, yes, I mean, the numbers up until now are not very inspiring, but that's kind of, behind us. And what the markets are obviously looking forward to is a recovery. And I think that conditions for that are gradually setting in, not just the environment, the fact that a couple of years of underperformance and lackluster growth out of that region, out of that segment, and interest rates now gradually getting out of the way as well. So I think you could probably look at better days ahead as far as the sector is concerned.
Okay, that's the auto space. By the way, Oberoi Realty is reacting quite negatively to its numbers, down about 4.5% on that one stock. Of course, it's rallied about 7-8% in July right now, undoing a lot of those gains. Tahir, what is your big takeaway from the earnings season? Because I don't think anyone's really thumping the table and talking about big upgrades. So were there any outliers for you because of which perhaps you'd want to go in and buy more, or where you think maybe a multiple re-rating could be on the cards? What's your takeaway? Are these earnings supporting a market at 19 times plus on overall valuations?
So yeah, I'd still like to think that we will probably, at least if you were to look at headline indices like the Nifty, etc., you might probably not see large upgrades coming around as yet, and it's probably going to be some time. There are some of these large sectors like tech and banks where it is very difficult to probably significantly upgrade numbers at this stage. So I don't really think that will probably be coming, but at this stage, I'm not very sure even that is required. I mean, we are at 19 odd times. It's not a very, very heavy market in terms of valuations being very demanding at this stage, especially if you're looking at the recovery being reasonably more broad-based as we go along. So I think headline valuations may probably not, headline numbers may not probably go up, but I think the undercurrent is pretty fine. When you look at sectors from companies from a broader basis across different kinds of sectors, we've seen decent amount of performance. For example, NBFCs have done well. We've seen somewhat of a patchy performance as far as tech is concerned, but by and large, banks, NBFCs have done pretty well. Some of the industrials obviously are doing well. Probably, they've run up too fast, so maybe markets are finding it challenging to reward them further. But in terms of the business performance, I don't really think that's been a challenge. I believe that consumption, which has been a drag, will probably start, joining the fray as well. So that's been on the sidelines for some time, and that's a sector which I think will contribute a lot more in the coming 12 months than what it has done in the last.
Hi, Tahir. Good morning. Tahir, what's the view on the pharma space? That was the under-owned sector, not done much in the last few years. I think in the last 1 month or so, that's been one of the big outperformers. Do you think the healthcare pharma space has more to go?
Yeah, I'd like to think so. We are seeing some strands of triggers coming through as far as the pharma space is concerned. After a decent amount of time, we've seen pricing erosion finally kind of bottoming out, if not getting significantly better. So that's a good sign. We've seen some evidence of that either in the form of bankruptcies in the US in the trade and distribution segment, or some supply tightness as well as far as that part of the market is concerned. So I think quite a lot of the problems of the last a good number of years is probably looking like getting out of the way. We've seen the domestic side hold up quite okay. There have been certain instances of a couple of products which are benefiting a good number of companies coming in to pick in some extra earnings. So my sense is that there's a relatively under-owned space over the last year or two. It's a good substitute from the point of view of domestic export markets, and especially if you want to look at external-oriented sectors. So I think it is a sector which has got legs, alongside which you also have the additional extended segment of the healthcare space, which obviously is a lot more domestic in nature. Hospitals, clinics, etc., which are also getting relatively more attractive, and the opportunity out there is getting better. So my sense is that this is a sector which will probably have legs. It will probably run a little more than what we've already seen up until now.
I wanted your thoughts, Tahir, also on what happened with Maruti, where the company, after 8 years, decided to sort of acquire SMG. And now that, earlier arrangement doesn't stand anymore, it spooked the street a little bit. Of course, there's weakness in numbers as well with the margins, etc. But what do you do as a Maruti shareholder?
So, like I said, this is once again one of the companies which is meaningfully levered to the lower income segment of the market, or the rural markets. They've obviously seen lack of action out there in the last good amount of time. I think that is probably something which will come back. New model launches, I believe, have started to help. The overall product balance is getting relatively more aligned to the market reality. My broad sense as far as this transaction is concerned, my view would be that it's finally good that it is coming back into the fold. It'll probably lead to deployment of cash, which is somewhat a little idle, and probably will be a little more productive than what it has been up until now. So my sense is that it probably looks like a decent development for me.
By the way, check out some interesting result reactions. Go Fashions is a very strong number. The stock's reacting positively, 9% up on Go Fashion. Revenues up 20%. Profits have jumped almost 80%. Some interesting stocks in the mid-cap side of the market bouncing around today on numbers. Tahir, you mentioned that you were expecting consumption to start participating more. And yeah, I mean, these big stocks haven't really led the rally. So what part of consumption? Are you looking at staples? Would you look at discretionary? And if it's discretionary, then what kind of companies? Or is it the Zomatos of the world? What do you have your eye on?
It's pretty diverse. I think, it will become a little more broad-based. I know that there have been certain challenges, competitive intensities being a little higher, especially in some of the white goods segments, etc. But to me, it looks like there's been adequate punishment which has been meted out to some of these names in terms of the stock performance as well as the valuations. It'll probably be a slow grind upwards, but I think if the demand situation gets a little better, some of these pressures will probably ease off. We are obviously seeing a reasonably comfortable scenario as far as commodity prices are concerned, and that should also kind of be supportive. So I think to me it looks like it'll broaden out even within the consumption space. I think it was only high-end consumer discretionary up until now. Probably it will get into a little more diversity. Low-end retail, probably even anything which is associated with, let's say, the low to mid-income segments of the market should start contributing a lot more meaningfully. So it could spread across a fair number of segments that we can think of, including probably consumer durables.
Okay, in consumer durables, this entire home improvement theme, just to take that discussion forward, of course, we're getting into that discussion with KGI Industries in a bit as well. But do you think valuations here across the board have become a bit stretched and there is caution, irrespective of whether the companies deliver good numbers or not?
So, as far as you're probably referring to the, so there are, once again, within the durable segment, there's different sub-segments. So if you're looking at the wires and cables and the home improvement part, that has done reasonably well and obviously supported by the good cycle in real estate. So I think, there I would like to think that maybe a good amount of money has already been made. But this is the other part, which is more of the, appliances, devices, other white goods segments. Some of the other, retail-oriented parts of the consumption market, which have not done well. And maybe one can look at them from a recovery perspective. They're not necessarily cheap, but clearly they are a lot more attractive compared to their own historic valuations.
Okay, all right. Tahir, thanks so much for joining. I request you to maybe stay on and listen to this conversation we're going to have with the KEI management, but appreciate you joining in and giving us your thoughts on a whole host of sectors. Well, that said, let's get straight to the stock in focus. KGI Industries, that's down close to around 3%. Expectations were high from the company, but it seems it's fallen a little bit short on that front. Mr. ONeill Gupta, the chairman and managing director of the company, joins us on the show. Hi, Mr. Gupta. Good morning. Well, it seems the street was building in, larger expectations. So let's get a couple of numbers out of the way. In the cables business, your revenue growth was close to around 13.5%. What was the volume growth?
The volume growth, good morning. The volume growth in cable business has been 22% as over the last, because the copper and aluminium prices and other raw material prices had come down. So hence, even in spite of clocking 22% volume growth, the revenue growth is only 14%.
Mr. Gupta, could that mean that you'll have lost market share? Because I'm looking at, Polycab, I'm looking at Havells. Their volume growth was 30 to 50%, while you have grown by around 22%. Explain this to us. Have you let off some kind of market share? Point number one. And point number two is, there is growth on the top line, but margins have dipped. Why is that?
We were a little constrained by capacities. We are building up capacities. I have been saying in my commentaries all through that the market is very strong. The demand is very strong. And it is a bit of delay in building up the capacity. And we are now, catching up with the capacity in all our existing plants so that we achieve a targeted volume growth, value growth of 16 to 17%. But definitely the volume growth should be in the excess of 20%. And we are also doing a large capex in our new factory coming up in Sanand, near Ahmedabad. At an investment of around 1,000 crore over a period of next 3 years. So the first phase of it should start by end of 24.
So you said revenue growth will be 16 to 17% for this year. You're sticking to that?
Yes, because the reason is we are in line with our guidance based on the available capacity.
And what's the margin outlook for the whole year? full year margins, Mr. Gupta?
We expect a margin of around 11% in EBITDA over a full year period.
Okay, 11% on margin. Now, I just want to dig a little deeper on the cable side of your business, where the house wire segment did really well. There's about a 33% year-on-year growth. The extra high voltage, the EHV segment, saw a big decline, almost a 50% decline year-on-year. So can you tell us, I mean, was this a one-off or what's happening? Because I think earlier you had said that you are expecting a run rate of almost 600 crores on a yearly basis from this EHV segment. Is that still on track? And what will make up the bulk of your cables business this year?
EHV business is on track, and we will definitely cross 600 crore, what we have said. It is because of the delay in clearances from the utilities on the execution side, due to which we have a very healthy order book position in extra high voltage cable. Due to delays in the clearances from utilities, the first quarter performance is dipped, but we will definitely cover it up in the second quarter, third quarter, and fourth quarter, and definitely it will be in more than 600 crore what we have guided.
Mr. Gupta, why has this delay happened, and how are you so sure that you could sort of make it up in the second and third quarter? I mean, could there be a possibility that this delay could continue in the next couple of quarters as well, continuing to hit your EHV segment?
No, all these projects which are in hand have been cleared now, and they are in production.
Okay.
So there is no question of any further delays.
Okay, got that. Your housing wire segment, there is a 500 crore figure that you've crossed in terms of quarterly revenues. Is this a run rate that you can sustain, and what kind of growth are you looking at? Because that's the business that has led the growth this time around.
No, this run rate will continue, but I can assure you even the cable business will also grow by around 20% in volume. Value depends on the prices of raw materials. So we are confident that as we are building up the capacities for cables and the wires, we already have existing substantial capacities. So we should be able to achieve a growth of overall 17% over a period of in this financial year, and also a volume growth of more than 20%.
Okay, all right. Mr. Gupta, your export contribution, I think it was around 10% odd. When we last chatted, you said I think it will be around 12% for FY24. But I'm just looking at your numbers. For the first quarter, it's around 17%. Do you think exports will contribute more in this year? And also just explain to us the margin profile between domestic and exports.
I expect that this percentage of export over a total turnover will continue. There is a substantial, demand from for our products in other markets, and will continue to grow in that. It's only a question of now building up the capacities to, grow further. So far as margin is concerned, I think the margins in export are almost similar to domestic, but definitely 0.5% more. And as the export grows, it will definitely lead to better EBITDA margins.
So exports will contribute 17% for the year, is what you're telling us? In that rough range, 16?
As a guidance, I'll say 15 to 17%.
15 to 17%.
Yeah.
Okay, 15 to 17% growth on exports. You mentioned capacities. I was just coming to that point. What is the capacity utilization rate at which your factories are currently operating? And are you looking to add any more capacities this year, FY24? Well, if so, then what's the cash outlay plan for this year?
This year, our cash outlay plan is around 350 to 400 crore, out of which more than around 100 crore or 150 crore will go into the existing plants in ramping up, by debottlenecking of the capacities. And another 250 crore will be spent in Sanand, where we are building up a large factory over, with a capex of around 1,000 crore. But that capacity will come up for production in the next financial year only. And with that, we should be able to ramp up our production by around 17 to 20% in our existing plants in current financial year, and also will be doing some ramping up in the next financial year also.
Okay.
Is there an increased focus on the retail side as well? I mean, currently, as a percentage of sales, your retail business has gone up quite a bit from around 30% in FY21. Now it's at 44%. Do you plan to increase this further? And what would this mean in general for your margins, the blended margins?
As I said in my earlier interviews, we plan to ramp it up, this retail business close to 46 to 47% in this financial year. So far as margin profiles are concerned, I think there's not much of a difference in the margin profiles in the retail as well as the B2B business. Maybe 0.5% more in retail business. And, we are definitely trying to catch up with our distribution network to have better penetration everywhere.
All right, Mr. Gupta, just to clarify, so you're saying that retail business margins are around 0.5% better, and also exports business margins are around 0.5% better. We got that correct, right? Marginally better.
Yeah. Yes.
Okay, final question then, Mr. Gupta. The concern for the street is, on a sequential basis, in your core wires and cables business, there's been a bit of a flattish margin to a mildly negative margin, while your peers have given margin expansion. So was there any kind of one-off in the first quarter? Why didn't KGI Industries see that kind of margin expansion? And also, by your calculation, what would your market share movement be in the first quarter? Because you've grown a little less than your peers.
You see, I have explained the reason for little lesser growth because of the capacity constraints. And yes. So far as margins are concerned, in the first quarter, because of the higher expenditure on IPL and advertisement, margin is dipped by around 0.5%. So otherwise, we'll see a overall margin of close to 11% over a full year period on a larger turnover. So we expect that we will be in line with our guidance.
Okay, thanks for explaining that to us, Mr. Gupta. Wishing you all the best. And it seems this time around the street wanted a little better set of numbers. That's why the stock is seeing some profit taking, but you're maintaining your guidance for the year. Appreciate you joining us on the channel. Well, time to slip into a short break. On the other side, we'll be joined by the managements of Castrol as well as IRB Infra to discuss their past quarter's numbers. Stay with us.
Welcome back to Corporate Radar. Let's talk about Castrol's numbers. It was a good set of numbers, actually. Both revenues and EBITDA witnessed healthy growth. The company also managed to maintain its operating profit margin level. Sandeep Sangwan, the managing director at Castrol India, joins us now to talk about that. Sandeep, thanks for joining us. Generally, when we get the earnings, we don't really get a handle on what the volumes have looked like. So can you help us with that? What was the volume growth this time? What was the realization growth? And what is a sustainable volume growth number you can do by the end of the year?
So, first of all, good morning to everyone, and thanks for having me on your channel. I think we posted, as you said, a good set of numbers. Our revenues up about 7% year on year. Our PBT is up about 9%, and I think it's a mix of volume and top line growth, revenue growth. So our volume growth would be in the range of about 4%. 3 to 4%, and I think we see that volume growth going forward. And the set of numbers has also been helped by some of the new product launches that we did. We launched magnetic SUV in the car segments because 50% of the new vehicles sold are cars. We entered a slightly lower price point category in the commercial vehicles with CRB Essential. We launched Castrol On. So overall, we're very happy with the results, and we've also declared an interim dividend of 3 rupees per share. So quite happy with the numbers, and we see the second half also. While I wouldn't like to give any guidance, but we see quite good second half coming through with cost inflation having eased in the last 6 months.
Mr. Sangwan, hi, good morning. So you gave us a sense of the volume growth, which you're confident on. What about value growth? Are prices rising, or are you holding the price line to encourage more volumes? And what's the outlook on that balance for the rest of the year?
Yeah, so typically we have a strategic pricing framework which we operate with. As you know, we are a premium branded player in the market, and we would like to hold our premiums. But at the same time, we also believe in giving the right value to our consumers and customers. So I think as we get into the second half, we'll keep that in mind in terms of delivering value to our consumers and customers. And typically in the first half, we've actually, some of the cost savings have been passed on to consumers and customers, but we would like to hold our margin at, normally we say we'll hold our margins at 23-24% level, and that's what we try and maintain.
So you've done some price cuts, is the sense that I get. You've passed on the cost benefits. Going forward, as you look to hold that margin line, are you expecting stability or more easing? What's the outlook?
We expect to see stability in the market now with some of the cost pressures having eased off, okay? But we never know how the next 6 months are going to turn out. We operate as per our strategic pricing framework and a band of premiums that we want to hold versus the average market prices. So we keep evaluating the situation and keep taking corrective actions as may be needed.
Okay, got it. All right. Good morning, sir. Thanks so much for speaking to us. Well, industrials is around 10 to around 12% of your business, I believe. How are you seeing that segment shape up, and do you want to increase the exposure out there?
So definitely, I think industrial is a key focus area. We operate in key segments of the market where we can differentiate our products and offer differentiated value to our customers for total cost of operation perspective. So it is going to be an important part of our business, and we see growth in that business. In the first half, we've grown in that business, and this quarter also, both top line and margins have expanded in that business. And I think as manufacturing activity picks up, and with the economy and in emphasis on capital expenditure, we'll continue focusing on that segment as a growth segment.
But, just coming back to this margin argument, right? You said that you're holding on to your margin guidance of 23%, but earlier, the quarter was supported because of lower crude prices, but now crude prices have surged yet again. So how are you so confident that you could hold on to this figure?
So I think we continue investing in our brand. We continue our advertising expenditure behind investing behind our brand. So that helps us hold our margins. And in an inflationary environment, as we saw last year, we're also able to kind of take pricing actions to protect our margins. And as I said in the beginning, we'll continue holding on that. And I think we also have some good new product introductions. We're expanding our network, so that also helps us. So for example, we have 350 Castrol Auto Services today across almost about 100 cities in India. We have 5,500 bike points. So we're working on various parts of our business to make sure that we are able to protect our margins, and we've done that historically. So I don't see any issue as far as that is concerned.
Okay. And this acquisition of Kei Mobility, can you tell us whether you've completed that, and what is the way forward? How does it add to your, your revenue stream?
Yeah, so I think that investment is progressing very well. We completed the transaction in January. I think Kei Mobility business is performing well. And we've also started kind of working together around synergy areas. For example, Kei Mobility has a spare parts offer, which we've been able to offer to our network. We are supplying Castrol branded lubricants to the Kei Mobility network, which is expanding day by day. So overall, we are very happy with the progress that that investment is making.
Okay. All right, Mr. Sangwan, we'll leave it on that note. Thank you very much for joining in. Appreciate you being with us. That's Castrol trends at the end of Q1. The market's completely flattened out, by the way. Just about 10 to 11 points higher on the Nifty. Very quiet session. And unlike yesterday, the mid-cap market, at least at the index level, is also fairly subdued, you'd have to say. Power Grid is a stock that's really selling off. It's down 4%. Beyond the earnings, I think there is a bonus as well that the company has announced. But there's disappointment written all over the Power Grid numbers as we see it right now. The other ones are UPL, of course, continues to drag. ONGC. Maruti is down only 0.5%. So Maruti has managed to, and the market's managed to digest that news on the Gujarat plant fairly okay. on Maruti. So not too much problem there. Look at NTPC go. That takes NTPC's tally in the last about 3 to 4 weeks of gains of almost 18%. It's been a blowout performance on NTPC, despite the top line actually being very subdued in the first quarter. But there are other triggers like their green transition, their plans on renewable energy. They've got that renewable subsidiary in which they may want to do some sort of a stake sale. So there are a lot of other triggers that's working well. Very, very good move on this one. Continuing. Pharma is a bit of a theme today. Cipla, Divi's, these are some of the names on the upside that are holding the fort for the Nifty. But otherwise, it's getting very quiet out there on the index, at least per se.
Okay, but a lot of these auto stocks are up ahead of their sales. So M&M, Tata Motors and the likes, and the ones that have come out, Hero Moto, Eicher, M&M, Tata Motors, all expected to come out with sales and all are higher in trade today. So let's see how the numbers go. But Nestle India's chairman and managing director, Suresh Narayanan, is bullish on growth, even as he says that food inflation remains a concern. In an interview with CNBC-TV18 Shireen Bhan, the Nestle India chief said that they expect volumes to grow 7 to 8% if inflation remains at moderate levels. Listen in.
21 quarters have been double-digit growth. In that, almost 15 out of the 26 quarters have been quarters of double-digit profit growth. The return on equity of the company is close to 100%. The innovation rate has been clicking at over 5% of sales. 7-year track record of the company shows an organic growth of close to 11% and an underlying volume growth of 7%, 7 to 8%. A strong trend towards premiumization of brands. So consumers are trending up in terms of certain categories, brands, and certain preferences.
Okay, that is Nestle. By the way, the next company on our radar is going to be IRB Infra. IRB had a bit of a muted quarter, you'd have to say. The revenue is down about 15%. EBITDA is down 26%. The margin is also contracted year on year. Margins come down from 55% to about 47%. So lots to talk about. The total order book, of course, is still a pretty massive 33,700 odd crore rupees. The company, by the way, has also announced a rights issue of 2,862 crore rupees for private InvIT. This is proposed to be undertaken this month itself. I think we do have the management with us now. ONeill Yadav, Director, Investor Relations and former Group CFO at IRB Infra is with us. Mr. Yadav, thank you for joining in. Let's start with the top line, which is down about 15%. What are the business trends like? Talk to us about toll collections on some of the major projects. What are the toll collection trends? And also on the EPC side, how did project execution shape up?
We had one-time income of roughly 418 crores on account of claim receipt for Amritsar Pathankot. That has led income higher by 418 crores, EBITDA by 373 crores, and PAT by roughly 279 crores. If we'll adjust for one-time income on account of the Amritsar Pathankot, and if I adjust in Q1 of FY23, and then we compare with the current quarter, then income is up by 11%, EBITDA is up by 17%, and the PAT is up by 59%.
And margin, so can you tell us? No, got that. Yes, there was that one time in the base quarter, got that. So if you adjust that, then where would the margins be? And can you tell us about toll collections as well?
Yes. So we have seen roughly 15 to 16% growth in the toll collection in IRB business, roughly 22% in the growth in the private InvIT business. On combined basis, IRB and private InvIT put together, we have witnessed around 18% growth in the toll collection.
Okay, 18% growth in the toll collection totally. What are the trends that you're seeing in the Mumbai-Pune Expressway currently? Earlier, you'd actually raised your guidance for the full year, right? You said that EPC revenues could be about 5,000 to 5,500 crores in FY24. Do you stick by that guidance, and what are the trends looking like?
I think one has to understand the business. We are about to start Hyderabad ORR and Samakhali. We are already on advanced stage on the financial closure aspect, and we expect this project to start in Q2 of FY24 itself. So we will have a robust Q3 and Q4. considering these two projects starting, both will contribute in EPC and toll revenue. And secondly, typically the second half of the year is much better for the infra companies.
All right. Hi, Mr. Yadav. Good morning. The construction business has been a degrowth for reasons that you just mentioned, down close to around 25% on a year-on-year basis. Last year, you did around 4,300 crores, and you've been mentioning, don't expect to see big growth out here. What do you end the year with on the EPC side of the business? I ask you this because your order book is only around 8,000 crores. So what is the revenue run rate we're looking at for FY24?
Yes. So we have an order book of 8,500 crores for EPC, and next 2.5 years executable O&M order book will be roughly 3,000. We have 11,500 plus crores of order book, and as we have given a guidance in Q1 of FY last quarter, that we will be reaching, basically having a growth of around 10 to 15% on EPC side. And with the two projects starting and their EPC contribution will start coming from Q3 and Q4, we still believe that we can, our construction business can grow in range of 10 to 15% as far as revenue is concerned.
Last year, the construction business was 4,300 crores. So you're saying on that base, it'll grow?
Yes. So from the 4,300, this year we will be reaching more than 5,000 crores of revenue.
More than 5,000 crores. Okay, we got that out of the way. Now, in the Mumbai-Pune Express, I think earlier you were guiding for around 1,600 crores of toll collection. I think first quarter you're in par, around 400 crores approximately. Just give us a revision of those numbers. What should that project contribute for this year in terms of toll collection? And will all of it be traffic driven? All the price increases are already done?
Yes, so probably with respect to toll collection, we have guided around 50 to 20% growth in the toll business on backdrop of the price revision and traffic growth. And typically, first half in toll business is typically on a lower side, and the second half is much robust. Typically, that translates between 45-55 kind of ratio. So on full year basis, we expect around 20% growth on toll business also.
Okay. Mr. Yadav, give us the total headline number. I mean, your order book, which right now is, I'm just revisiting that big number, 33,708 crore. At the end of the year, where do you see this number? And what will be the mix between, the BOT projects and, let's say, the EPC side of the book?
Yes. With respect to, as we have guided in the past also, whatever order book we are consuming on EPC side, we will try to bag at least 20% higher of that order book. So roughly 6,000 to 7,000 crores of EPC order book for this financial year. We have already bagged a large Hyderabad ORR project, which will contribute in the toll revenue, and also has an O&M order book of roughly 14,000 crores of O&M order book till end of concession. So then definitely the TOT project also provides for the visibility for the toll revenue as well as O&M order book also. So by year end, we believe that whatever EPC will be executing, our order book will grow at least 20% from here on. So probably
that's a total
close to 10,000, 9 to 10,000 crores of EPC order book.
Mr. Yadav, okay, wait, so just to clarify the numbers, 9 to 10,000 crores is going to be your EPC/construction order book, and you will add an incremental 14,000 crores in O&M, whether it's TOT or BOT. Is that right?
14,000 is already added. So if you look at the March order book, it was close to 20,000 on backdrop of 14,000 crores addition, because we have bagged the Hyderabad ORR project in April. So that has already added in the order book.
Okay. This Gujarat project construction revenue, I didn't get that. What are you looking at in terms of a timeline? And will it come in FY24 itself?
Yes. For Gujarat project, we have already signed the concession agreement. We are on advanced stage as far as financial closure is concerned. Once we achieve the financial closure, we expect to start the construction of the project in this financial year itself. And this being 4 to 6 laning project, this will also contribute in the construction as well as in toll revenue.
Okay. And can you tell us a little bit about the price hike as well? What is the blended price hike that you've seen in Q1 so far, and what is the expectation as we move along in the next couple of quarters?
So this year, most of the project we have a 5% tariff revision, except Mumbai-Pune, where the tariff revision was as predetermined rate. On Mumbai-Pune Express Highway, this was the last tariff revision, and there will not be any further tariff revision on Mumbai-Pune Expressway. And with respect to the NHAI projects, this year we have received a 5% tariff revision. We expect around 5% tariff revision in future as well.
All right, Mr. Yadav, what's the status of the Ahmedabad-Vadodara claims? When do we expect a resolution out there?
On Ahmedabad-Vadodara, the arbitration is still going on. And as we have discussed in our quarterly con call, we have received the interim arbitration award, which has the interim arbitration award was in our favor. We are expecting the final award within next 4 to 6 months' time.
Okay. Finally, Mr. Yadav, why are you raising money in the InvIT? You're doing this rights issue. What's the game plan?
Yes. So Hyderabad ORR project total capital outlay is 8,400 crores. And out of that, 3,000 crores is the equity requirement. And the 3,000 equity requirement will be met 51% by IRB and 49% by GIC. So the right issue, what we are doing in the private InvIT, that will be subscribed by 51% by IRB and balance by GIC, and that will be used to fund equity requirement of Hyderabad ORR.
Okay, all the best. Thanks a lot for joining us. That's IRB Infra. There's a 10 to 15% growth that they're looking at in the EPC business, and they speak about their total order book as well. Market, by the way, is not bad. The mid-cap index is now picking up a little bit of pace, up about 133 points. So Mitesh Thakkar is with us to give us more on that. Mitesh, your thoughts on what's happening in the index? A lot of stock-specific reactions. Anything that catches your mind?
So on the stock side, I think that's what we've been advocating, that basically it's a market which will be consolidating and action will happen in the broader markets. So I think that's where traders should focus upon. I have two calls right now. Chambal fertilizer, we have seen Coromandel make new highs. Chambal is reversing after a correction, so it could be starting a new trend. That's a buy with a stop at 276 or 275 half, and a first target of around 290 can be looked at. Though eventually, I expect the stock can go higher. And also a buy on L&T Finance, which I would recommend buying with the stop just below levels of 131 and a target of around 141 can be.
Okay, got that. Thanks very much, Mitesh, for the details over there. Let's move on to some of the stocks that are active and that are in focus. Here's the Nifty's biggest loser of the morning. It's Power Grid. Vivek, what's happening with this one after numbers?
Well, absolutely. Going into the numbers, this particular stock was a clear outperformer, and a lot of that is being reversed now, as the company has delivered slightly subdued set of numbers against what the consensus was building up, in anticipation of Q1. Number one, it's been mainly the weak commissioning trends that the company saw in Q1 that's actually gone ahead and impacted the earnings. Remember, along with the earnings, the company has also gone ahead and declared a bonus share issue. So for every 3 shares you hold in the company, you get 1 additional share. Talking about the numbers themselves, revenues largely flat on a year-on-year basis. Analysts were anticipating at least a marginal uptick as far as revenue growth was concerned. EBITDA, slightly higher on the back of improved cost controls, up 3.5%. Margins, have improved on a year-on-year basis, but despite that, profitability has actually gone down almost 6%. Now, talking about the segmental revenues, there's been a couple of misses over here. Consultancy revenues have gone down almost 47%, still a very small part of the overall revenue pie, but despite that, coming in at 124 crore versus 234 crore last time around. The company is holding a management lead today as well. So post the analyst meet, there will be some more clarity in terms of what exactly is the commissioning target as well as the capex target that the company is planning for the rest of FY24.
Okay, thanks a lot for that, Vivek. Well, we are watching out for a couple of auto stocks as well that have come out with their numbers for July. And Bajaj Auto's numbers are actually lower than what the street was estimating. The total sales have come in at 3.19 lakh units versus Nomura's estimates of 3.28 lakh units. It's also a fall of 10% overall that we're seeing in sales, led largely by a steep fall in exports this time. Exports are down 18%. That comes as a disappointment because the management had indicated earlier that July onwards is when they'll see a recovery in exports, but there's still a big double-digit fall, and two-wheeler sales are down about 15%. But for Escorts, the tractor maker, the numbers are good actually. Total sales growth of 3.9%, largely led by the domestic sales, which are up almost 10%. And the management commentary was also quite positive. They expect sales to continue to improve in the months to come, especially in the festive season starting September. So a little bit of a mixed bag is what you're seeing in the auto segment. Let's slip into a quick break. On the other side, we'll shift focus to the commodity markets with Manisha Gupta. Welcome back. Well, let's get a quick handle on what's happening in the world of commodities. Manisha is here with us. Manisha, what's the one commodity that you're looking at?
I'm looking at the crude oil prices, Sonia, because this is one commodity that has consistently continued to gain on the higher side. We have seen 16% of gain come in for the month of July. It's a fifth weekly gain that we posted in the previous one. And the month of July has been the best month in 18 months that the crude oil price is actually posted in sense of gains there. Well, the strength comes in on the back of strong U.S. fuel demand, which is at the highest since 2019. Overall fuel demand has been high, but the U.S. gas demand also seems to be surging up, and we've seen that one come in at the highest since June 2022 as well. And the markets will keep an eye on the supply side of the issues as well. Saudi Arabia is going to extend 1 million barrel per day of an oil output cut in the month of August and then in September as well. If you look at the overall OPEC output, that has continued to decline as well. So the Saudi Arabia output has seen a decline by nearly 860,000 barrels per day in the month of July itself. They're also has been a Goldman Sachs report which has been quite interesting, and the markets are reacting to that. The global demand has risen to a record 102.8 million barrels per day in the month of July itself, even as the street was talking about recession and lower demand concerns there. Goldman Sachs also goes on to say that for 2023, they're expecting the global demand now to rise more than 550,000 barrels per day there. The markets will look at the unplanned outages that we've seen from BP. This is happening in Canada's Whiting refinery. This is one of the biggest ones in Canada. The supply concerns also have added premium to the prices. And then the OPEC output cuts, when you look at that in the month of July, has been the lowest since September 2021. So the output from Saudi Arabia, overall OPEC and allies, continues to be on the weaker side. So there could be further tightness going forward within this quarter as well. So when you look at the overall output, last month was at 28.1 million barrels. For the month of July has been 27. And OPEC is looking at further cuts coming in for the month of August and September. So those numbers are going to be interesting to watch out for. More importantly, you have OPEC and allies meeting on 4th of August. This is about demand and supply review going forward for the rest of 2023. For the month of July, this is the report card for what the energy as a sector has done. The only commodity that has seen a decline has been coal. That one is trading at a 2-year lows, by the way. But for the month of July, it has been a 16% gain for crude. Gasoline and heating oil also gaining more than 20 to 25% there.
Okay, and that's something to really keep in mind when it comes to cues for the equity market here. Thank you very much for that, Manisha. So literally oil on the boil. With that, we are going to take a very quick break. But on the other side, our special segment is the economy. Lata today gets chatting with Ashok Gulati of Indian Council for Research on International Economic Relations to discuss India's decision to ban rice